So I'll let Richard walk you kind of through these, but this is how we feel that our approach is different here in AI, but also we have a very similar approach to the other types of investing that we do.
So there's four prongs to our approach. The first Hannes kind of alluded to in the last few slides, but looking for these underappreciated and misunderstood assets. They're not your pure play AI companies, and they're not your obvious hardware manufacturers, but they are applied AI. They're known for something else, but AI is helping accelerate or transform the business. And we need to look very, very wide, and we actually use AI to help us sort the whole universe of stocks. But we've developed a proprietary scoring system, and our thesis is that there's two factors that matter. It's data and distribution. If you have specifically proprietary data, if you have specific proprietary data that other people don't have, then you can feed it into one of these now commoditized models. As you may have heard, companies like Meta will spend $1 billion and release a model for free. So you can't really make returns off of that. But if you have your data, you can then apply those models, and you can get a result that Meta wouldn't be able to get themselves. And then if you have the distribution, is you already have an existing business and existing pool of customers, you can create new products, distribute them effectively before others can catch up, and basically create a better business moat, and have that advantage in the economy. Um, the other two factors, if you go back a slide or forward, so so we're going beyond the S&P 500 here, because S&P 500, that's where all of your passive flows are. That's where you have the 30% of the money in just 7 stocks. We think that these are also the most appreciated companies with the most analysts covering them. So if we can find companies that are not yet included in the indices, but are growing very quickly, and we can screen for that very intelligently, looking for growth at a reasonable price, looking for positive unit economics. That doesn't necessarily mean oftentimes the companies are not bottom line profitable, but they're growing so quickly at the gross profit line that they can generate economies of scale and operating leverage, and eventually be included in all these passive index funds, and that's a great front running opportunity for us. Also, it just happens that more often than not, from what we've seen, the smaller companies are able to be more nimble with applying new technologies. So we like to look at those specialized use cases. And then lastly, we do think it's a mistake to be a pure thematic investor, or especially a sector specific investor. What we've seen is a lot of times in various sectors, you'll have a winner, not necessarily a winner take all, but a few winners take most type of dynamic. And if you spread your bets in a single sector, you could basically have your winners are being offset by your losers within that sector. And so what we'd rather do is try and have a diversified approach with the valuation discipline and the individual researches into a variety of different sectors, and figure out where AI is transforming specific sectors, and then create a diversified portfolio. And this can kind of complement a core equity portfolio.